So let's talk more about futures, options, and hedging. Like, what does it mean to hedge? What is a future? And what are options? And should you include these in your portfolio? Well, hedges are basically a bet that's the opposite from a current bet that you have. It's generally done in a way that if you're taking a long position in a stock, but you think that over the short term, maybe they're not going to perform very well, so you take a short position on the stock as well. That way, if the stock does go down, you can still make money while your long position is losing. So when large investors do this to minimize any potential losses, and they are generally handling large amounts of capital, and even in the worst financial conditions, they need to protect their clients' money and make sure that there are opportunities to still engage with the market and come away with gains. While that might sound great, these strategies can get tricky. So if you're new to investing or if you're a retail investor, we're not recommending that futures and options are something that you'd want to leverage. If you want to hedge by taking a short position against a long position, that's not a big deal, but as we talk more about futures and options, you'll understand why this is something that only the prepared should really be utilizing. And you'll find people all over the internet that will talk about how much money they made off of futures and options, but I'd encourage you to ask them about their largest losses and see what you think before you decide to jump into this game. This is more designed for institutional investors, but trading platforms do allow you to buy futures and options, so we just want to spend a little bit more time covering them for your awareness. Now, options trade in multiples. For example, they'll trade at ratios like 10 to 1, 50 to 1, 100 to 1, or 200 to 1, which means that if you have a 2-cent price movement and you have a 100 to 1 option, then your option will move by $2. So you can imagine when there's major market swings, your options can have dramatic price changes. Now that can lead to very quick riches, but it can also lead to total loss. So when you're trading options, balances have to be cleared out at the end of every day. So if you have a $20,000 bet on some options and they make some movements and the movements lose $12,000 on that day, which is totally feasible, that balance gets cleared out of your account on that day, and the next day you only have $8,000 available to invest. So you can understand then when somebody who just lost 60% of their portfolio will then take an even riskier bet to try to win it all back. And what ends up happening is they lose it all, or worse, they end up owing the bank money. Options trading can be very risky, and if you're not properly diversified, you can very quickly lose a lot of money. And certainly it's not something that we recommend you engage with as a retail investor. I know individuals whose families have lost their entire fortunes, like large ones, because one family member started playing around with options. So just be aware that it's something that you really want to study up on and have a good understanding of before you begin to take this on. And with futures, like we talked about a moment ago when discussing commodities, these tend to be products that are more designed for corporations to engage with in order to secure raw materials. For example, if you're a corporation that's delivering packages and you need to purchase large quantities of fuel for your delivery vehicles, one way that you can ensure a stable average cost of your fuel is by purchasing futures contracts to guarantee that you can take delivery at a certain price. Then as the price rises, the value of that contract increases. And you have two options. You can either hold on to that contract until maturity and take delivery of the fuel below market value, or you can sell the contract and take a premium, and that premium you receive for that contract, you can apply to offset the rising cost of your fuel, making your average cost of fuel more acceptable. So large institutional investors will also use futures because if they think that the commodities prices are going to continue to go up and that demand isn't going to soften, they'll go ahead and buy those futures and potentially even take delivery on them if they feel that holding on to those goods for longer periods of time is going to be worth it. And for corporations that are publicly traded and need to deliver on their forecast to Wall Street, this type of hedging allows them to maintain commodity prices for longer, and it gives them a chance to deliver on their forecasts while still reacting to market conditions. Now, that's really what futures and options are to help corporations stabilize their inputs so that they can have a better chance to deliver on their promised outcomes. In addition to using financial products for hedging, some people prefer physical gold and silver bullion. And while the value doesn't fluctuate as much, it's more of a hedge against a currency rather than an investment. For example, many people online buy into what we'll call the SHTF theory. This theory would involve the collapse of our society, at least in the way that we currently know it, and wealthy individuals want a way to protect themselves and their family's wealth in the event of this type of collapse. So by purchasing gold and silver bullion, this is generally done as a protection to be able to maintain your status within society. People who do it thinking that they will actually trade these coins today will likely run into difficulty doing so. Silver coins are easier to use since one coin is worth about $20 to $24, but gold coins aren't as commonly traded. Now, still, physical gold and silver can be a great way to ensure stability in uncertain times. So if you're buying gold or silver, you want to make sure that you're getting it from a good, reliable source. There are lots of places that like to advertise, but there are also many people out there that will try to take advantage of you. Also consider where you want to store these metals. You can keep some of them in a safe at your residence, but mainly you'll want to keep it elsewhere, like in a safety deposit box at your bank, or if you like watching spy movies, apparently lockers at bus and train stations work pretty well too. No, I'm just kidding. Don't use a locker in a public place. I also wouldn't recommend burying it in your backyard either, but it is your money, so it's up to you what you want to do with it. Also, unlike your stock investments, don't advertise this hedge to your friends. They might not be a threat, but they could be bragging about your stash one day when someone a little less friendly overhears. So use discretion when talking about this and when showing off any bullion. And keep in mind that when the market goes down, people are less enthusiastic about the future, and that's typically when gold and silver prices go up. So if you're in good times and precious metals are priced low, you may consider picking some up. Market conditions are always changing, and if there ever was some type of currency collapse, then you're protected and you can maintain your position within society. Now, some other savings products that are out there that can be pretty beneficial to you are things like college savings plans. These plans can be something that you contribute to throughout your child's life, and there's something that a lot of states in the US also offer tax rebates for making contributions. So if you're donating to a college savings plan, sometimes there's a portion that you may be able to get back on your tax return each year, which is pretty cool because it's essentially free money and it can compound and help your children out in the future. Another savings option to be aware of are health savings accounts. You have to have a high deductible healthcare plan in order to qualify, but this is another way to take some of your money from a pre-tax standpoint and to contribute it into an account to use for healthcare expenses. The accounts act as a way to help you offset some of that higher deductible and to help you cover other out-of-pocket expenses. And even if you don't use the funds, some accounts allow you to invest the money above a certain balance, helping you earn an even higher return on your pre-tax savings. Money market accounts are offerings that you can find at some banking and investment institutions. Essentially, they're just savings accounts that offer a rate more similar to a CD. They typically have minimum balance requirements, but these are great accounts if you don't want to tie up your money in a CD or a treasury, and it keeps it fairly liquid and you can earn a healthy interest rate. Then there are fixed income annuities. You can get these from financial institutions and some insurance corporations. These are typically low-risk products with a guaranteed income. A lot of people that are in retirement or are about to retire generally are encouraged to consider these. It's just a way to make sure that you're going to have a stable income over time. Now, a criticism would be that they don't offset inflation very well. And to give you an example of how one works, say you have $100,000, and rather than investing it and attempting to get a 6% return every year, you go to an insurance company and they give you a policy where they guarantee you a 5% return and a monthly payout over the next 30 years. To be clear, at the end of 30 years, it stops. There's nothing to keep you from reinvesting your monthly payments, but most people use this as a type of product to help cover bills during retirement. Fixed income annuities aren't products that you're going to buy and sell like stocks, and you can't get in and out of them as easily as other accounts. But for people at certain stages in their life, they can be a great way to secure their future income and allow them to contribute to their risk-free portfolio. So if you're struggling with what else to consider for your risk-free portfolio, or if you're at or near retirement, you should definitely consult a professional to see if an annuity is the right product for you.